Welcome back to the Capital Market, your TV show on stocks, bonds, T-bills, and every other securities constituting the Nigerian capital market. Before the break, our guest, Mr. Ayodele Akinwumi, who is the head of research at FSDH Merchant Bank, was giving us an insight into the trading week in light of the two key events that transpired this week in the economy, and that includes the Q1 GDP report as well as the decision of the Central Bank of Nigeria maintaining a hold on the rates after their two-day rates setting meeting. But then the committee had welcomed the positive domestic economic performance, the fourth consecutive quarterly GDP growth, an improvement in the manufacturing and non-manufacturing sectors, evident in the Purchasing Managers Index readings that we've seen so far, sustained inflation, deceleration, and many more indices, macroeconomic variables that we've seen. However, it noted some upside inflation risk factors, including supply chain disruptions in major food producing states amid security challenges, as well as the impact of global inflation on domestic prices. Mr. Akinwumi, before the break, you were talking about the kind of trend that we've been seeing in the T-bills and the fixed income markets generally. Let's have you conclude that portion before we get your reaction to the decision of the MPC as it affects the fixed income markets directly.
Okay, thank you very much. Again, so what I said is, as yields in international market begins to go up, the attractiveness of Nigerian fixed income securities drop.
Okay.
And therefore, as the instruments they bought here mature, so we have seen that they are not rolling over and they are taking the money out and to weigh the available investment options. And that's what we are seeing in the investors and the exporters windows.
Okay, so but doesn't this amount to a form of capital flight? And because of the kind of fears of that investors often have about elections in Nigeria, the MPC, for example, voiced the fears on excessive spending as a result of that. Don't you think it will stifle the repatriation of proceeds eventually?
Again, I'm being careful not to send
the wrong signal
to the people, to investor, both local investor and foreign investor. We do not have fear. Yes, election consideration, the MPC has mentioned it. They will need to, if they spend in second half of the year, the central bank, the foreign investors may also be looking at it. If they feel that there is elevated spending, there may be a need for them to tighten. If they tighten now, the yield that we are seeing may then wants to go up. If the yield go up, it means prices will come down. Then let's take our money now a little bit, take advantage of the rising yield in international market. Then when the yield goes up, we can come back. So those are various dynamics that the investors across the board, both the local investors and foreign investors, particularly from the foreign investors angle, may be thinking about. And that's just what, but not really, I don't want us to send a negative signal that investors are afraid and they are taking money.
But shouldn't we just say the way it is? And then if you have to invest, you invest. If you have to exit, exit, and then come in at the same time.
And that's what we are saying. So the market is stable, the market is balanced, the market is liquid too. If you want to exit your position, it's your money. If you think they want to roll over, the market is able to take you out. If you want to come in, you can come in freely. Free entry, free exit makes the market balanced. So that's good. I think we need to be happy about that situation.
Okay, so this week, for example, we didn't have T-bills auction from the CBN, but next week we should be having about 100 billion naira repayment on the part of CBN and only a rollover of about 50 billion naira. What does this tell you about the kind of trend that we will see next week in the markets?
Well, there may likely be some liquidity, which the central bank may likely use OMO to mop up a little bit again. And again, it is also in line with the strategy of the Debt Management Office, which I mentioned earlier, to shift part of a large percentage of the federal government debt obligation to the long end of the market, so that they will be able to allow people, private sectors who wants to issue commercial paper, and in the long end to issue the money in the market, which I think it is very good for the economy.
So, but then there should be more moderation on prices.
Yes, there may likely be a moderation of prices, but like I said, there is a limit to how this kind of work. The central bank is there. If it feels that there is too much money in the system, they will use OMO to mop up. If they think there is the money in the system is not in line with what they think it should be, they will sell bill to the market, and that's how they use their monetary policy instruments to moderate the liquidity in the system.
So what kind of impact will that leave on the secondary markets eventually? Should make things attractive?
Yeah, it may make it, I mean, that's what we've been seeing, but in a number of few weeks now, the yield here seems to be a little bit higher at almost level than what we have at the level. But the market, again, will still have to adjust itself to the yield that will clear the market.
Okay, especially on the supply side of things anyway. Well, basically, let me hear your thoughts now on the decision of the CBN and the concerns that the CBN governor raised. I believe you know all of that.
Okay, so the old rates, FXTH Research was one of the analysts that felt there was time for the central bank to ease policy. And I need to make it clear, like we released in our report, we think that yields in the market have not moved, have moved in a way that does not have any relationship with the MPR. So MPR at 14%, so yield have come down, like I mentioned earlier, so no relationship. Now, what does MPR stand for in the market now? MPR, a lot of lending are predicated on MPR. So, and we have fragile growth in the economy, and we are saying the time for the central bank to ease policy to stimulate growth is now. But they decided against that principally on two things. Number one, I mean, we've seen, again, price stability in the market, inflation coming down, exchange rate stable. So we think that they have been able to manage the economy in such a way that should allow them to ease that policy. More also that it doesn't even have any relation with yields in the market. Now, but lending are predicated on that. So if you allow that to come down a little bit, the lending rates that are based on MPR, maybe certain premium over MPR, may likely be adjusted when the repricing of those loans are going to take place, which will make the real sector to attract a little bit of more funds at a cheaper rate and to accelerate growth. Because we have an economy that even the major sectors of the economy, even the general economy is growing at a rate that is lower than the population growth rate in the country. So in real growth, we are growing at a negative rate per capita. So we need to, stimulate the economy from all angles to ensure that we have growth rate that will be able to create jobs that will be higher than our population growth rate. And that was what we said. And also, if you look at all the money supply aggregate growth rate that central bank set for the economy, they are all growing at a level that is lower than what we see, what we have now. So I think but central bank talked about the fact that the cost of managing the liquidity system may be very high. Expectations.
But don't you think that was exaggerated?
Well, again, I don't want to say it is exaggerated.
Because over the years, we've been used to, election and inflation in Nigeria being cost push, basically. It's not, I don't think it's about that.
Yeah, central bank also give it to them. They have more information than we have.
Yeah, I agree.
Again, so if they discuss something as a credible institution, we want to agree what they say. Yes, cost push inflation is what we are having at the moment, not really the demand that's driven by demand. If there is no structural rigidity in the economy, if we remove those things, inflation will come down. I mean, the way it is now, even though they don't do anything, inflation will continue to drop based on base effect.
I hope inflation continues to decelerate, actually. I really want to see it at single-digit point. Mr. Ayodele Akinwumi, Head of Research at FSDH Merchant Bank, thank you so much for honoring our invite in Capital Market again. We do appreciate your comments. Thank you so much.
Thank you for having me.
On that note, that's it on the program this evening. We appreciate you watching. I'm Temple Ashaju. See you again next time. Bye for now.